Yeah, good afternoon, all of you. The light session that Samir was talking about is here. This isn't going to be a very hard session. My objective, as Samir has put out, is to keep you awake for the next 20 minutes and try my best. The future of home finance, Samir articulated a lot of data. I don't have any data, in fact, in my presentation. Samir articulated a lot of the use case for, digital, how the lending business is being transformed, etc. So I'm just going to give you a little bit of a perspective on a lot of non-digital things, from a business side. The future of home finance as we speak right now is being rewritten, not just with brick and mortar, but with APIs, alternate data, and analytics today. This is what this business is about. In fact, someone was asking a question in the previous session. You had asked a question about the role of distribution in lending. I guess, I think Samir's answer was spot on. I think the transformation has happened already. That role is, today technology is the backbone for digital. If you don't have technology, there is no point in having 200 branches. And, that really worked 10 years back. 10 years back, having 200 branches was a moat. But today, technology is probably where it is. So we'll talk about, these four pillars of the tech transformation, the digital transformation, risk management, sustainable growth, and the trust part. Typically, the fintechs start on the left side. Digital transformation is what we all keep hearing. But from a longer-term perspective, for an institution to succeed, we need to get the risk management part of the equation right to continue this journey. The home loans, I can speak for is really moved from the thick files that we all used to see in the past to a digital revolution. Today we talk about having apps for everything. Every single process has an app. People go through that app, apply for loans, underwriting happens, processing happens, everything happens on the app. So to that extent, the transformation has already happened, or it's happened in large part. There are still some parts which are manual for various reasons, not for want of effort, but for regulatory reasons. Therefore, the real question is not about do we need to digitize? The question actually is how fast can we digitize before someone else eats our lunch? That's the question that we are solving for. This is something that all of us know. Why do we need to go digital? The speed is certainly something that we cannot manually compete with. The precision targeting, there are lots of things that we throw our money on, and in the previous session that Samir spoke about, the number of files or applications that we spend our time on that don't see the light of the day. So therefore, the targeting, the precision targeting helps us zero in on what we want to focus on, where we want to spend our time and energy in. The risk intelligence. Risk intelligence is now real time. Every EMI paid, every loan that is closed adds to the intelligence in the database. And for all of it, if you want to scale up this business, we need to have this technology backbone. Scaling up of this business, when you have 10 branches and 20 branches, is easy. But when we are talking in multiples of hundreds, you need the digital interface. But having said this, the credit quality is a non-negotiable. We still, with digital interface, without digital interface, we still go through the income verification, the property verification, the behavioral matching or scoring of these customers, etc. So all of technology is a great enabler to do this business, but eventually there will be an element of human judgment, whether it is in the form of framing your policies, or whether it is in the form of managing those edge cases. You still need to have a credit officer looking at those exceptions to apply his or her mind on. But the challenge is, do you want someone applying their mind on 100% of the cases, or do you want them to focus on that 20-25%, leaving the rest to the digital interface? That's also the key to unlocking the productivity of the entire team. Technology has really been a great leveler for companies. This really puts the small financial institutions on the same weight class as the bigger banks in terms of throwing their punch at, attempting to do various things. You no longer need to be big to do everything else. All you need to do is to have the right amount of the interface, whether it is data aggregation, scoring models, decisioning, and continuous learning and improving the database. All of this is certainly something that the digital interface is helping us do, and also helping us bridge the gap between the big boys and the new age players that have just starting out. This is the opportunity that we are looking at. This is a fairly big opportunity. The numbers are just going to grow and just going to blow out of proportion in the next few years and decades. The convergence of the housing demand, the digital literacy, and the fintech innovation that we see here presents probably a once-in-a-generation opportunity for all of us. But if we don't get this right, this also means that this is a big risk that we are all assuming, and that's something that we need to manage well. So how do we navigate this growth? Certainly, we've seen over the last few years, the housing finance businesses have grown fairly high double digits on a CAGR basis over the last 7 to 10 years, but so have the losses. There are players, or there are pockets of the industry that have certainly witnessed higher losses than others. The key learning here is that a growth without a risk discipline is certainly a faster route to failure. That's the thing that we need to watch out for. So therefore, the successful players will certainly have the guardrails built into their growth engine for survival. How do we build a sustainable balance sheet? Certainly, a digital front end is very sexy, but a disciplined balance sheet is the key to survival. So all of our focus, should be on building a better balance sheet. Everything else that we talk about in terms of lending, digital framework, etc., is a means to an end. The end is certainly having the financial wherewithal and build a robust balance sheet that helps sustain the challenges that we navigate alongside. The trust equation. How do we build a trust equation? The real promise of digital, to me, is not about how fast we can lend to an affluent customer. Can we do this better, faster to an affluent customer? The real promise is, how do we get those underserved people who've been ignored by the traditional models all along? That's the key to digital interface. This is not about, can I lend to a metro customer, a housing finance customer in a metro, can I approve them in 20 minutes or 7 minutes? This is not a blink-it game. This is about, how do I make financial inclusion easier, better using technology. Prudence, we keep talking about risk management, prudence. Prudence is not the enemy of innovation. It's not an enemy of inclusion. It's about, you need to survive to make sure that you serve the underserved segment. So if you blow up your balance sheet, you won't be around for the next quarter to serve the rest of the team. certainly digital brings a lot of good things at a faster pace, growth, innovation, and new customer acquisition, etc. But it also brings a lot of mistakes along the way. So we need to find a way to learn from our mistakes to continue to grow. Over the next few years, we will be left with only two sets of companies that have done really well in digital and mastered this and have become success stories. The rest of them will become acquisition targets. So to conclude, this is not just about building a balance sheet. This is about serving a customer, serving an aspiration of a customer. So digital interface is certainly a great way to go, great way to scale up, etc. But if you can keep the discipline of risk management alongside and bring that to fore, I think that's probably going to serve the fintech business as well as the financial services business very well. So thank you very much and have a good afternoon.
Thank you so much, sir. And that's token of appreciation from Samir sir. And thank you so much for presenting so well.